Let me ask you something. Imagine waking up tomorrow morning and reading a headline that feels impossible. A major war has just begun. Not a distant conflict you scroll past on the news, not something happening quietly across the ocean, something that suddenly feels close enough to make people uneasy. Markets open, stocks drop, oil jumps. News anchors start speaking in that careful tone that says more is coming. And somewhere between the headlines and the speculation, a quiet question appears in your mind. What happens to my money if things get worse? Do savings survive? Do markets collapse? Does inflation spiral out of control? Or does life somehow continue just slightly more expensive, slightly more uncertain than before? History gives a surprisingly clear answer. War does not just change politics, it changes money. Governments spend differently, prices move differently, markets behave differently, and people who understand these patterns tend to protect their wealth far better than those who assume everything will remain normal. Today, we're going to walk through what actually happens to money during war, not the dramatic movie version, the financial reality. Because once you understand how economies behave during conflict, something interesting happens. The anxiety around money becomes quieter, more manageable. You start seeing the difference between real financial risks and the fears that headlines exaggerate. And more importantly, you begin to understand what ordinary people can do to protect themselves. If this long-term thinking about money helps you see the world more clearly, consider subscribing and giving the video a like, but only if you genuinely find it useful. Now let's talk about what really happens to your money when war enters the picture, and why the first thing war attacks isn't your savings account, it's stability. When war begins, financial systems rarely collapse overnight. Movies love dramatic scenes where banks close and markets implode. Reality is quieter. At first, everything still looks normal. Stores open, paychecks arrive, the grocery store still sells milk. But underneath that ordinary surface, the financial environment begins to shift in ways most people don't immediately notice. Governments suddenly need enormous amounts of money: military equipment, fuel, transportation, logistics, personnel. Wars are some of the most expensive events a nation can experience. And the moment conflict begins, governments start making financial decisions at a speed and scale that would normally take years. They borrow heavily, they issue bonds, they redirect budgets. Central banks begin preparing emergency policies, and investors around the world start quietly reassessing risk. None of this feels dramatic in daily life, but it changes the financial atmosphere, and households begin to feel something subtle. Not panic, but uncertainty. Employers become cautious, companies delay expansion plans, financial markets grow more sensitive to political news. The system begins operating under stress. This is where the first rule of financial protection appears. During uncertain periods, financial fragility becomes dangerous. The person whose entire lifestyle depends on every paycheck arriving perfectly on time feels pressure immediately. The person with large debts and no savings suddenly realizes how narrow their margin for error is. But the person with financial breathing room experiences the situation very differently. This is why historically, the most resilient households during crisis are not necessarily the richest. They are the ones with margin, savings, low fixed expenses, manageable debt. Financial stability during uncertain times rarely comes from predicting events. It comes from building resilience before events arrive. A household with 6 to 12 months of savings does not panic when headlines worsen. They observe, they wait, they adjust if necessary. But they are not forced into immediate decisions, because financial flexibility creates psychological calm. And during uncertain periods, calm is an asset. But even when households are stable, another financial force begins working quietly in the background of almost every war. A force that rarely appears dramatic at first, but over time, it touches almost every wallet in the country. Inflation. If you study the financial history of wars, one pattern appears again and again. Prices rise, not immediately, not explosively, but steadily. War requires enormous spending, and governments have only a few ways to pay for it. They can raise taxes, they can borrow money, or they can expand the money supply. Most wars involve all three. But the third one, increasing the money supply, has a powerful side effect: inflation. More money begins circulating through the economy. Demand increases. Production shifts toward military needs. And suddenly, everyday goods begin creeping upward in price. Groceries cost a little more. Energy becomes more expensive. Transportation costs rise. And slowly, the purchasing power of money begins to shrink. Economists sometimes call this the quiet tax of war. Because unlike official taxes, inflation does not appear on a bill. It simply makes the same paycheck buy slightly less every year. This is why people who hold all their wealth in cash often feel the impact first. Their bank balance may remain unchanged, but what that balance can buy quietly declines. History has shown this pattern repeatedly. From World War I to modern conflicts, wartime economies often experience higher inflation than normal. Not always catastrophic, but noticeable. This leads to an important financial lesson. Cash is excellent for stability, but it is weak protection against long-term inflation, which is why historically people who maintain financial resilience during inflationary periods often hold a mix of assets: productive businesses, equities, real estate, investments that have the ability to adjust with rising prices. Because when companies raise prices for their products, their revenues often rise as well, meaning the value of those businesses can increase even when inflation erodes the value of cash. This does not mean abandoning savings. Cash reserves remain essential for short-term stability. But relying exclusively on cash exposes wealth to a different risk: the slow erosion of purchasing power. And that brings us to the next financial pattern that appears during war, something that surprises many people, because despite the chaos in headlines, financial markets often behave in a far more structured way than expected. Financial markets react to war the same way humans react to sudden danger. First comes fear. When conflict begins, investors often sell quickly. Stocks drop, volatility rises, headlines predict catastrophe. And if you watch markets during those first days, it can feel like the entire financial system is unraveling. But history shows something interesting. After the initial shock, markets often stabilize far sooner than people expect. Why? Because economies do not stop functioning during war. Factories continue producing, governments continue spending, companies adapt to new demand, entire industries reorganize around wartime needs. Defense production expands, energy demand shifts, infrastructure spending increases. Some sectors suffer, others expand dramatically. Markets eventually begin pricing this new reality. During many historical conflicts, stock markets recovered long before the wars themselves ended, which reveals an important financial lesson. Panic selling during crisis often locks in losses that long-term investors would otherwise recover. This does not mean markets are immune to war. Far from it. But the biggest financial mistakes during crises often come from emotional decisions: selling during panic, buying during euphoria, and reacting to headlines rather than long-term economic reality. Investors who maintain diversified portfolios and avoid emotional reactions historically perform far better during periods of geopolitical stress. Because markets are forward-looking. They adjust, they adapt, they continue functioning. But while markets often stabilize, another financial risk can quietly appear during prolonged conflict, one that most people rarely think about until it becomes relevant: currency instability. Most people think of money as stable by default: $1 today, $1 tomorrow, the same value. But during extended geopolitical stress, currencies can come under pressure. Governments managing wartime economies sometimes take extraordinary financial actions: capital controls, exchange rate adjustments, currency devaluations. These policies are designed to support domestic production and manage international trade, but they can also change the value of a currency relative to others. This does not happen in every conflict. Many stable economies maintain strong currencies even during war. But history shows that diversification across currencies and global assets can provide protection against localized instability. This is why many investors maintain international exposure in their portfolios: global businesses, international index funds, assets tied to multiple economies rather than a single country. Diversification does not eliminate risk, but it spreads it, which is often enough to protect long-term wealth. And while currency risk is one consideration, the most powerful financial protection during uncertain times often looks surprisingly simple: liquidity, flexibility, and manageable expenses. Because when crisis arrives, wealth rarely looks like luxury. It looks like resilience. When people imagine wealth, they often picture visible signs of success: luxury cars, large homes, expensive possessions. But during periods of economic stress, those symbols become far less important. What actually matters is flexibility, the ability to handle disruption. Households that navigate crises usually share a few characteristics. They have accessible savings, They maintain diversified investments, they avoid excessive debt, and their lifestyle does not require maximum income to survive. This structure creates something powerful: optionality, the ability to adapt when circumstances change. Someone living comfortably on half their income can absorb financial shocks far better than someone whose entire salary is already committed to expenses, which leads to a realization many financially stable people eventually reach. Wealth is not about how impressive your lifestyle looks. It is about how resilient your financial structure is, and resilience becomes even more valuable when uncertainty rises. But even with good financial structure, one final factor determines how people behave during crisis: psychology. So let's step back for a moment, because when people hear the words war, markets, inflation, and currency risk all in the same conversation, the mind can start imagining dramatic scenarios: bank collapses, economic chaos, savings disappearing overnight. But history tells a calmer, more practical story. War absolutely changes economies. Governments spend more, inflation often rises, markets become volatile. Currencies can experience pressure. Yet the financial outcomes for ordinary people are rarely determined by the conflict itself. They are determined by the structure of their financial life before the crisis begins. And once you see that pattern clearly, the list of what actually matters becomes surprisingly simple. First, liquidity matters. Cash reserves create breathing room when uncertainty rises. They allow you to absorb temporary disruptions without making rushed financial decisions. Without liquidity, every unexpected event becomes a crisis. With liquidity, most problems simply become inconveniences. Second, manageable expenses matter. A lifestyle that requires every dollar of income leaves no margin for instability. But a household living below its means has something incredibly valuable during uncertain times: flexibility. They can adapt, they can wait, they can make decisions calmly instead of under pressure. Third, diversification matters. No one can predict exactly how any specific crisis will affect markets, currencies, or industries. But diversification spreads exposure across multiple outcomes: different companies, different sectors, different regions. Instead of relying on one financial system, you allow several systems to support your wealth at the same time. Fourth, productive assets matter. Cash protects short-term stability. But over long periods, assets tied to real economic activity, businesses, real estate, productive investments, tend to adjust alongside inflation and economic shifts. They continue producing value even when the financial environment changes. And finally, psychology matters, perhaps more than anything else. Because during uncertain times, fear becomes contagious. News cycles amplify anxiety, predictions multiply. People feel pressure to act immediately. But the individuals who protect their finances most effectively are rarely the ones making dramatic moves. They are the ones who remain calm enough to follow the plan they built before the crisis: savings, diversification, reasonable expenses, long-term thinking. In other words, the same financial habits that create stability during normal times are exactly the ones that protect wealth during uncertain times. Which leads to a surprisingly simple conclusion: the best way to prepare for unpredictable events is not to guess when they will happen. It is to build a financial life that remains stable even when the world becomes unpredictable. And that kind of stability rarely comes from complicated strategies. It comes from simple rules followed consistently over time. There is one more uncomfortable truth worth mentioning. History shows that war and crisis do not only destroy wealth, they also rearrange it. That idea can sound strange at first because conflict is undeniably a time of hardship. Economies strain, people lose jobs, prices rise, entire industries struggle. But when large systems are forced to reorganize, something else happens quietly in the background. Opportunities appear, not in an obvious lottery ticket way, but in the slow structural shifts that change how wealth is created. During and after major conflicts, entire markets reset. Land becomes cheaper in certain regions. Businesses change ownership. Industries that once dominated begin to fade, while others expand rapidly. Infrastructure is rebuilt. New technologies developed during wartime suddenly find civilian use. Housing markets, manufacturing sectors, transportation networks, and energy systems often undergo massive transformation. For people who are financially stable and psychologically calm during these transitions, those changes can create opportunities that rarely exist during comfortable times. Land that was once expensive may suddenly become accessible. Businesses may sell at prices that would have been impossible during economic booms. Entire neighborhoods and industries can begin rebuilding from the ground up. History contains many examples of people who built enormous wealth during reconstruction periods following conflict. Not because they exploited chaos, but because they had three things when others did not: liquidity, patience, and the ability to see long-term potential while everyone else was focused on short-term fear. They bought land when it felt risky. They invested in businesses when confidence was low. They participated in rebuilding economies when most people were still recovering. And over time, those decisions transformed not only their own lives, but often the lives of their families and communities as well. This does not make war desirable, far from it, but it reveals an important truth about economic systems. When disruption occurs, the financial landscape reshapes itself. Prices adjust, assets change hands, new industries emerge, and individuals who remain financially prepared and mentally steady are often in the best position to participate in the rebuilding that follows. Which brings us back to the core idea behind everything we discussed today. The goal is not to predict crisis. The goal is to build financial stability strong enough to survive crisis and flexible enough to recognize opportunity when the world begins rebuilding again. Because throughout history, the same periods that tested people the most often became the moments that reshaped entire financial futures, for individuals, for families, and sometimes for entire generations. War changes economies, it shifts prices, it reshapes industries, and it introduces uncertainty into systems that normally feel stable. But history also teaches something reassuring. Financial resilience rarely depends on predicting the future, it depends on structure. Savings that create breathing room, investments that grow with the economy, diversification that spreads risk, and a lifestyle that does not require perfect conditions to survive. People who build those foundations rarely need to panic when the world becomes uncertain, because their financial life was designed to handle uncertainty long before it arrived. And that quiet preparation often makes the difference between fear and stability. If this video helped you see money a little more clearly, stay. Subscribe. We're not chasing hype here. We're building financial clarity.